Market volatility spiked up recently, catching many investors by surprise. These seemingly unpredictable market movements can prompt investors to think that they need to take drastic actions. In times like these, it appears everyone is asking the same questions. Should we get out before the market tanks, and if so, how soon? In fact, on average, markets historically have pulled back by 5% 3 times in any given year. Going back to 1979, the S&P 500 has had an average intra-year decline of 13.6% from peak to trough. But the market finished with a positive return in 33 out of those 39 years. There can be some years when the market is abnormally calm, like in 2017. In that year, the peak to trough decline was just under 3%, the smallest intra-year pullback since 1995. As hard as it can be to embrace market volatility, sharp swings on the upside and the downside are a normal part of investing. One of the most important investment principles to remember is that risk and return are related. What does that mean exactly? If stock markets offered investors a smooth ride all the time, then there would be no risk and everyone would rush to invest in equities, thereby limiting the potential returns you could gain. When we look back at history, it's clear that investors who have been able to weather the ups and downs of the market have been rewarded for their discipline.